This episode of Talk Your Book is proudly brought to you by Stock Doctor.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Andrew Muchaka, thanks for coming on Talk Your Book.
Pleasure to be here.
I thought we might start with Flinders Investment Partners. What's your guys' investment philosophy?
We're a Melbourne-based funds management business. This is our 5th year now, but we've been in the industry for collectively over 60 years. I know it sounds like a lot, and it is a lot, but that's important for the market that we operate in. We're partners in the business. That means we're aligned to our investors. In terms of our philosophy, we focus on one asset class only, which is Aussie small caps, and that's all we do. So the important point there is we don't have competing products such that or any good idea we identify goes straight into the portfolio. So for us, trying to identify that growing company early is really powerful from a returns perspective for our investors. And that's why we see between 500 and 600 companies every year, or at least have as many meetings as that to try to identify those companies.
And what company do you want to talk about today?
Today I want to talk about a company that's been listed for a reasonable amount of time, almost 15 years, called Quickstep Holdings. They're an Australian-based manufacturer in that composite end of the market and specifically focused on aerospace. This company produces components for defence spend and namely military aircraft. That aircraft there, and particularly the programs they're involved with, specifically the Joint Strike Fighter program, is only open to countries that are sponsors of the program. So right now, there's 15 countries. There were 16, but Turkey were booted out in July because they're using Russian anti-aircraft ballistics. So they've been booted out. But the beauty of that is any sponsoring country is allowed to offer up their manufacturing or their services into the program. And what's particularly attractive to us is that after being listed for so long, they only turned a profit last financial year. And to me, it's a deeper story than that. And it speaks to how well the business has come along and why it's an attractive opportunity now.
And their main customer is out of the US?
So what's fascinating about, tiny little minnow businesses out of Australia, 100 million market cap, their clients are the US Department of Defence.
Yeah.
Now that, you think about that, it's the biggest defence spending entity globally. And they've managed to provide certification for a little minnow in Australia to actually produce product for them. So yes, they are the core client right now, not limited to them down the track, so the opportunities for them are multiple or numerous, but certainly right now it's the US Department of Defence.
And you hear investors talk about non-correlated assets all the time. Do you see a business like this have a lack of correlation, almost an inverse correlation to the rest of the economic environment?
A couple of things to note there. Certainly their earnings is exactly how you described it. They are defensive earnings. They're not tied to any, they can be tied to the fiscal budget of the US market, but let's face it, in the recent decade or two, the amount that's being spent on defence out of that market is quite substantial and growing.
And they had a good AGM presentation last week. Talk us through some of the financial metrics of the company now and some of the forecasts for the next 12 months.
There's very little by way of research in this part of the market. There is some, but the detailed analysis, and certainly at Flinders, the hallmark is the work that we do. So we produce our own research in this area. And in responding to your question, the AGM was quite positive because it talked to, firstly, an inaugural profit, which is great. Yeah. And secondly, it talked to the opportunity set. Now, they generated substantial revenue growth last year from about $58 million revenue in FY18 to just over 70 million. They've talked about $80 million worth of revenue this year, which doesn't seem as strong, but the power comes below the line. The gross margins have improved substantially, and that goes to the work that the new management team have put into place to drive scale, to drive manufacturing efficiency. So manufacturing is typically tight margin business, but at the same time, when you're operating in the defensive space, it's probably some of the highest value manufacturing that can be done globally. So, on a like-for-like basis, automotive versus military, it's probably 5 times the value, frankly. And it goes back to the precision and the quality of the product as well. I mean, they produced a profit of 2.7 million last year. The reality is that profit is, on the back of the efficiencies they've put in place, will grow pretty rapidly. So we've got them doing 40% CAGR over the next 3 years.
And there's a bit of a gap between their earnings and their cash flow in the last 12 months.
Yep.
They put that down to increased inventory. Can you talk us through how you got comfortable with that and what their inventory cycle looks like?
Yeah, it's not purely about the inventory itself, but it's also about the products that they're producing. So it's the work in progress, and the work in progress has to be accounted for somewhere on the balance sheet, and typically it gets accounted for. It gets accounted for as it's a liability to an extent, because, and it has to be funded.
Yeah.
So that work in progress needs to be funded. So that impacts the cash flow.
What's the sort of lead time on that by the time they have to buy materials to the time they've got a finished product that they can sell in a ballpark sort of?
So in an estimate, because they produce a number of different products here, so I would argue a unit production might be 12 or might be a month to produce that product. So you've got to carry the inventory, but in the end, you're carrying the product through that life cycle. So from our perspective, in order to gain comfort in that is to understand the nature of the contracts. And the nature of the contract, specifically the lead contract with the F-35 fighter bomber, is that it was very much front-end loaded. That means in the past they'd benefited from upfront payments on the program. Now, ultimately that has to wash itself through. So in order for that to happen, so in the last quarterly, you would have seen the last quarterly came out just after the AGM. That talked a negative cash flow of $5 million. Now, to us, that wasn't a surprise. It may have been to the market.
Yeah.
But the reality is, when sitting down and discussing the detail with management and understanding the nature of the contract, that provides an understanding of what their capital cycle is. So for us, Alan Tilley, who's the new CFO there, has been there 12 months. He was clear that over the next 12 months, they should right-size their cash flow. So you won't see that. That was a relic of the original signing, or the recontracting of the first contract that they had with Lockheed, and hence we would expect to see cash flow improve over time.
And there's a lot of talk more broadly about globalisation coming to an end and moving more towards a regional trade type environment around the world. Having a contract with the US Department of Defence, does that really preclude you from having one with China or Russia or a country that's not an ally to the US?
I think in this case it probably does. And really, using Turkey as the example, they were sourcing product from a non-NATO, non-US ally sovereign nation, and that really destabilised the relations between the groups. So that would have made it quite difficult. In terms of whether they could manufacture, you certainly couldn't do it out of that facility.
Yeah.
That would not happen. Potentially, I'd think it'd be very difficult.
Yeah. The relationship between Australia and the US is so strong. Is that a risk at all that the US will move where they want to get all these parts manufactured in their domestic economy?
I think the opportunity set for this company is not just the US Department of Defence, going back to the original comment. They can operate in the commercial market. The commercial market is 5 times as large. Now, the margins may not be as good, but it's a scale commentary as well. So once they can actually hone in on the most efficient manufacturing techniques within their facilities, that's really, they can really take on that sort of work and drive margin. So it's not just about the Department of Defence.
And the forecasts look really strong for the next 12 months, and you've talked about the next 4 years. Are there any other milestones that they could potentially achieve in the next 12 months where you could see them get re-rated, other than the increase to earnings and cash flow that we
So we talked about the growth in and itself looks pretty attractive, and they have some organic opportunities to grow the book. But we value the company this year, and on our numbers is on 17 times, but that belies the growth, because next year it's 13 times and then it's 11 times. So when you've got a market that's trading on 20 times, these are they're really attractive numbers. Going back to your question about other opportunities are out there, they are in exclusive negotiation currently for a reasonable sized project, which will require them to spend capital. But the beauty of it is their facility in Bankstown has the capability of taking on more work. I think they're real opportunities, but I don't think they're the only opportunities. I mentioned to you commercial aircraft. I think they're real. They still have their technology in the business, which they've been working up for the last 15 years, that lives within the business. I think it's all about commercialising some of that technology.
And they're about 100 million market cap company, so a small company. The directors and the CEO own less than 1% of the share capital. Does that concern you as an investor? Would you like to see them own more, or is it something that is of little regard?
So there's a couple of things there, and it's important to recognise that in this universe, and you rightly point out, it's not uncommon for a chairman, CEO to own a large proportion of the business, and we certainly don't have a problem with that at Flinders, as long as they're looking after the minority shareholder. That's critical for us, because ultimately that puts into question their governance. So we actually screen on an ESG basis the companies that we look towards investing in, but primarily it's not a philosophical bet, it's more about protecting long-term risk. For us, what's important is that they actually have a view towards ensuring profitability now in the most efficient manner in terms of driving costs out of the business and also driving sales.
Well, it's an interesting business. I really enjoyed having a look through it, and really appreciate you coming on and talking us through it. Thanks for coming on.
Appreciate that. Thanks for your time.
If you're interested in building your own investment process, make sure you check out Stock Doctor, the proud partner of Talk Your Book.